If you are a business owner and you are not writing off your expenses correctly, you are leaving thousands of dollars on the table and handing it straight to the IRS. I am Noura, a tax accountant and the founder of Noura's Books. And today I'm going to break down exactly what a business write-off is and what qualifies, what doesn't, and how to make sure you are maximizing every single deduction legally available to you. Stay until the end. I have something that can save you a lot of money this year. You can skip this part if you know what write-off means. But if it's your first time hearing about it, it's a business deduction, an expense that the IRS allows you to subtract from your total business income. This reduces your taxable income, which means you pay taxes on less money. It's that simple. The IRS says that to be deductible, a business expense must be both ordinary, meaning common in your industry, and necessary, meaning helpful and appropriate for your business. That's the two-part test, straight from the tax code. Quick example. If your business earns $100,000 and you have $30,000 in legit write-offs, you only pay taxes on $70,000. That difference can mean thousands in savings depending on your tax brackets. Let me walk you through the categories most business owners overlook or underuse. Home office deduction. If you use part of your home regularly and exclusively for business, you may be able to deduct a portion of your rent or mortgage, utilities, and internet. This is one of the most underused deductions. And yes, it applies even if you are renting. Vehicles and mileage. Every mile you drive for business purpose counts. You can deduct using the standard IRS mileage rates, which is 72.5 cents per mile for 2026. Or you can deduct actual vehicle expenses. Keep a mileage log. This is where people get audited because they do not have documentation. Business meals. Business meals with clients or team members are 50% deductible. The meal must have a clear business purpose. Always note who you were with and what was discussed. A receipt alone is not enough. Education and training courses, books, certifications, and coaching that improve your existing skills in your current business. They are deductible. This video script, if you hired a copywriter for your business, that's a write-off too. Software and subscriptions. QuickBooks, Zoom, Canva, your scheduling software, email marketing platforms. If you use it for business, write it off. Many business owners forget recurring subscriptions, simply also because they do not do bookkeeping. Health insurance premium. Self-employed. If you are self-employed and pay your own health insurance, you may be able to deduct 100% of those premiums from your taxable income, not just as a business expense, but as an above-the-line deduction. This is a big one. Retirement contributions. Contributing to a SEP IRA or solo 401k as a self-employed person not only builds your retirement, it directly reduces your taxable income. For 2026, you can contribute up to 25% of net self-employment income to a SEP IRA up to $72,000. Now, let's talk about what will get you in trouble. Not everything that feels like a business expense is one. Here are the most common mistakes I see. Mistake number one, personal expenses mixed with business. Your Netflix subscription, your gym membership, unless it's specifically required for your work, your personal groceries, those are not deductible. The IRS is very clear. You cannot deduct personal living or family expenses. Mistake number two, no documentation. I cannot stress this enough. If you get audited and you cannot produce a receipt or records, that deduction is gone. Use a bookkeeping system. Photograph your receipts and reconcile monthly. Do not wait until tax season. Mistake number three, claiming 100% of mixed use expense. If you use your phone for both personal and business, you can only deduct the business use percentage. Document how you calculated it. Here's what I want you to understand. Write-offs are reactive. They reduce the income you already earned. Tax planning is proactive. It changes how and when income flows into your business, what entity structure you use, and how you compensate yourself. The business owners I work with who go from paying too much in taxes to keeping significantly more cash, they are not doing anything illegal. They are simply implementing strategies that the tax code was literally written to reward. Write-offs are the beginning of that conversation, not the whole story. If you watched this far, you are someone who takes your finances seriously. And that is exactly who I built Noura's books for. I help business owners and individuals understand their numbers, reduce their tax liability legally, and build the kind of financial foundation that actually supports the business they are trying to grow. If you want to sit down and look at your specific situation, your income, your expenses, your entity structure, and walk away with a clear picture of what you could be doing differently, I would love to have the conversation with you. The link to book a call with me is right below this video. It's a strategy session, not a sales pitch. We look at your numbers, I give you real insights, and together we figure out the best path forward. Go ahead and click the link, choose a time that works for you, and I'll see you on the call. And if this video helped you, share it with another business owner. And if this video helped you, share it with another business owner who needs to hear it. Because too many people are overpaying and they do not even know they are. My name is Noura Al-Masri. I'll see you next Monday.